Thank you, Dimitri, for those kind words of welcome, and it is indeed a pleasure to be again in an initiative of the Levy Institute. So, as the title indicates, I'm going to speak about the growing out of the crisis is fixing finance enough, because that was the general sort of subject of our conference. So, in the wake of the financial crisis, which started in 08 or even 07, and 2 years later evolved into a sovereign debt crisis, there is little evidence that the European economy will soon be returning to robust growth. Risks for growth remain tilted to the downside, as we have said several times. Many European countries are facing low growth prospects and are plagued by record high unemployment, especially among the young, pointing to a considerable slack in the labor market, lack of demand, and subdued inflationary pressures, which in turn complicate the deleveraging process of sovereigns and households. There is now a real but mild recovery going on, and there are, of course, a number of narratives about what can and should be done to restore growth in the European continent. Foremost among these is the idea that the economic recovery is hindered by weaknesses of banks' balance sheets, and that if the weak European banks were to be fixed, growth would inevitably return. Naturally, we are aware of the negative effect that bank weak balance sheets and deleveraging has played by restricting the normal flow of credit to the economy. The ECB has gone to great lengths to support the bank lending channel, and we are now conducting an asset quality review coupled with stress tests to ensure the completion of banks' balance sheets repair. Furthermore, the banking union, consisting of genuine supervision, and European resolution, will be the most far-reaching change introduced since the inception of the euro. European countries participating in this project can rest assured that systemic risks will be better addressed in the future, enhancing financial stability and boosting the credibility of banks. Nevertheless, I would like to offer 2 points of caution with regards to the benefits of restoring a well-functioning banking sector in Europe and its contributions to growth. First, how to take advantage in terms of growth of a dynamic and sophisticated financial industry without running into the risks it tends to create. Second, is restoring a well-functioning financial system sufficient for robust long-term growth? The first question is important because even though financial intermediation undoubtedly contributes to economic growth, the crisis has reminded us that finance can breed instability, and that the welfare costs of instability can be very high. It is important that we are aware of the trade-off between growth and stability when designing an institutional framework for the future where finance will not be excessive. The second question is even more important as it speaks to the degree to which we can expect robust financial sector-driven growth in Europe once the banking union becomes operational and all problems related to banks' balance sheets are properly addressed. It is my contention that the European economy is gripped by problems that are even more serious than bank deleveraging and also more consequential because it is not immediately clear how to address them. I will argue that even when bank balance sheets are fully repaired, structural problems related to the slowdown in emerging markets, to weak domestic demand, and to structural phenomena such as aging population will continue hampering European growth prospects. The empirical literature on finance and growth has accumulated a substantial body of evidence on the positive relationship between financial development and long-term economic growth. From the academic literature, we have learned that countries with higher levels of financial development grow at a faster rate. Industries which have a higher need of external finance and face better growth opportunities grow faster in countries with a higher level of financial development. This positive effect has a well-known underpinning. Financial deepening alleviates financing constraints at the firm level, allowing firms to grow by engaging in higher capital investment and R&D investment, among others. This large body of evidence strongly supported the view that by inducing a positive resource allocation by supporting the creative destruction-driven process of technological innovation, financial deepening has a transformational effect on the real economy. At the same time, the global financial crisis of 2008 reminded us about the perils of finance. And since then, academic research has suggested that financial development does not have a uniformly positive effect on economic growth at all levels of financial intermediation. The evidence points to the fact that there is a threshold beyond which the positive effect of finance on growth starts petering out. We have several papers published also by our researchers pointing in that direction, and the BIS paper puts the threshold at 100 to 150% of GDP. There are different reasons for this concept of a threshold. For example, an excessively large financial industry can lead to a migration of talented individuals away from productive sectors. Alternatively, as the financial sector grows too large, financial intermediaries can start taking on excessive risk, and this behavior can expose the economy to large macroeconomic contractions. In other words, while we know that we need a well-functioning financial sector, we need to pay attention to its evolution. At reasonable levels, finance is essential for growth. But once it grows to an excess, the damage it can do can easily wipe out the positive contribution. This is why we should resist the efforts of the industry to push back on regulatory reform with the argument that more finance is always good for growth and jobs. Fortunately, we will have now a leverage ratio that can take control of the overall size of the financial sector, and this indeed will require, in my view, that the Basel definition will have to go above the 3% of the initial proposal, as it has been the case recently approved in the US. During the financial crisis, financial intermediation in Europe was greatly impaired, and the recovery in credit supply has been slow at best. Credit standards on loans to enterprises by euro area banks tightened by around 40% during each quarter between Q3 2007 and Q2 2009. After a stabilization period, they started tightening rapidly again in the summer of 2011. This process reflects the rapid leveraging that banks have been engaged in. For example, only between May 2012 and November 2013, the collective size of the euro area bank balance sheets dropped by 3.5 trillion euros, more or less almost 10% of the total balance sheet. Households and firms in the euro area have been strongly affected by this contraction of credit. Over the same period, lending to non-financial corporations dropped by 361 billion, or 70.5%. In light of my discussion on the effect of finance and growth, this is not necessarily an unnatural development. The euro area financial sector was overextended before the crisis. In particular, the transformation ratio of credit over deposits was at the level of 144% in 2007, and it's now at 119. So as I said, the euro area financial sector was overextended before the crisis, with the balance sheets of the largest euro area banks remaining even today among the largest in any region in the world. Contraction is the only way to bring the financial sector to a more reasonable size, which is relatively more conducive to a long-term economic growth. Of course, we do not fail to recognize that in a recession environment, Bank deleveraging makes policymakers' goal of encouraging lending to non-financial corporations, and especially to SMEs, which provides the bulk of employment in Europe, very problematic. Many countries, even though there is a substitution for bigger firms by using the financial market. In fact, in the last 12 months, the decrease in credit was totally offset by an increase of issuance of corporate bonds. Many countries have in the past experienced boom-bust episodes brought upon by some sort of financial market excess. The three major types of such excesses are asset price booms, credit booms, and real estate booms. The recession that follow any of these episodes are deeper than standard business cycle contractions. They are even deeper when two of these excesses take place at the same time, and they are deepest when all three are present, as it was the case in some European countries. The global financial crisis was preceded by all three, and so the sluggish recovery of the European economy simply reinforces the conventional wisdom. The resulting state of affairs is a so-called creditless recovery in the euro area. We are witnessing right now the coexistence of low levels of credit to the private sector and 3 consecutive quarters of positive GDP growth. And all indications are that the first quarter of 2014 will show also positive growth. Such creditless recoveries are far from unusual. 1 out of 5 recoveries is creditless, and output growth during creditless recoveries tends to be lower than output growth during recoveries when the financial sector is not impaired. Such recoveries are particularly common after financial crises and are often preceded by high levels of private sector indebtedness. Nevertheless, it seems that declining bank credit to the private sector does not necessarily constitute a constraint on economic recovery once output has bottomed out. Moreover, credit growth and output growth tend to be uncorrelated in the aftermath of financial crises that were preceded by credit booms, suggesting that private sector deleveraging does not necessarily put a threat to the post-crisis recovery. A recent BIS paper extends the previous evidence that existed for emerging economies also to advanced economies. International evidence suggests that recoveries following financial crises are often not simply creditless, but also jobless too. In other words, following a financial crisis, it's not uncommon to have a recovery without finance. This is an important observation and one that is at odds with the conventional wisdom that finance is indispensable at all moments for growth. One hears numerous voices that these days urging European policymakers to repair the balance sheet of banks so that they can lend again and in the process jumpstart GDP growth. There will be no growth without finance, the narrative goes, and the fact that the US has returned to robust economic growth faster than Europe would be in those narratives due to a large degree to policymakers acting quickly to repair the balance sheet of US banks. This narrative, while intuitively compelling, is missing 2 crucial points. The first is that bank balance sheets in the euro area have to a large extent been repaired already. For instance, taking the top 20 European banks, since 2008, they have increased their capital in absolute amounts net of share buybacks by around 60% more than the same increase in the top 20 American banks. As a result, large parts of the sector now fully comply with the minimum capital requirements under Basel III, well ahead 2018. The remaining weaknesses will be addressed in the near future, and once the architecture of the banking union is operating, after our comprehensive assessment of banks' situation, I expect that the European banking sector will be in a solid shape. But even if we were to agree that finance is a necessary condition to growth, it is far from clear that finance is a sufficient condition for jump-starting growth in Europe. I will argue that even a complete rehabilitation of the euro area's banking system, which is well on its way, thanks to the various policy steps related to the banking union, will not guarantee a quick return to high growth and low unemployment. In fact, there are a number of issues that the euro area economy is facing which are potentially more serious than the damage that the financial crisis and the subsequent euro area crisis did to the euro area banking sector. These issues are also far more difficult to address. Let me talk briefly about what I believe are the chief obstacles to growth in the future. I want first to highlight three short-term obstacles or difficulties in Europe: the slowdown in emerging markets, the fall in domestic private investment, and a weak domestic demand. I will next move to longer-term considerations. Chief among the short-term factors is the remarkable slowdown in emerging markets, which became, over the last years, more important than before for European exports. Take as an example the four BRIC countries. While in 2007, these countries grew at an average rate of 9.8%, in 2013, they only managed a rate of growth of about 4% on average, the lowest growth rate in more than a decade, if we exclude the crisis in 2009. This was largely due to country-specific factors, such as possibly excessive investment in China, and infrastructure and regulatory bottlenecks in Brazil and India, just to mention a few. This process is necessarily accompanied by a reduction in demand for foreign goods, among which euro area exports. This is bad news for the euro area, whose recovery so far has been largely driven by export strength. In addition to structural issues, there are a number of potential risk factors that have not materialized yet. A second important factor is the large drop in domestic private investment following the onset of the global financial crisis. Between 2007 and 2011, private investment in the EU 27 fell by 15% relative to its 2007 level. This compares with a mere 0.2 drop in private consumption. While it's not unusual for private investment to fall sharply due to a contraction in real GDP, its contribution to the latest contraction in the EU is among the largest on record, and some countries have seen unprecedented declines. For instance, over the same period, private investment declined by 27% in Spain, by 47% in Greece, and by 64% in Ireland. Today, private investment is almost 20% below a 25-year trend that came to an end with the financial crisis. The third important factor is weakness in domestic demand. This is often left out of the public discourse, but micro evidence suggested that it is a problem that cannot be appreciated enough. For example, SMEs interviewed for the ECB's survey on access to finance and small and medium-sized enterprises in the euro area have consistently cited finding customers as their most pressing concern. This fact points to serious problems that euro area corporates face on the demand side, which seems to be more pressing than problems coming from the bank lending channel. For comparison, while in the latest wave of the survey, 24% of euro area SMEs cite demand concerns as the most limiting factor in their operations, while only 16% cite access to finance as their most pressing concern. Of course, this is not to say that financial sector weaknesses are not important or that they are not recognized. On the contrary, the massive comprehensive assessment of banks' balance sheets that we are now undertaking is proof enough that we take that importance very seriously. My point is rather than while the ongoing deleveraging in the banking sector certainly plays an important role in the inadequate current levels of credit supply to the real economy, factors related to the demand side are even more important. The weak demand outlook combined with slack industrial capacity is the most important explanation for the drop in private investment during the crisis and the most important limiting factor for future investment. Let me now turn to the other fundamental challenges for growth that lie ahead of us for the world economy and in particular the euro area. After almost a decade of relatively high-paced economic growth and subdued inflationary pressures in the period preceding the crisis, the Goldilocks era, we thought that the potential growth rate of the world economy could continue along the same trends. The global financial crisis has partly shaken our certainties about the sources of global growth, namely, first, an endless growth of world population, global trade, and financial integration. Second, the contribution of emerging markets to a separate engine of world growth. And finally, the impact of technological progress, largely driven by the information technology and communications revolution. Let's assess the solidity of these pillars of global growth 5 years after the start of the global financial crisis. According to a recent report that has been produced by the Center for European Policy Studies, global population will peak by 2030. Even if its negative consequences on future growth has to be weighted against the positive effects stemming from contained pressure on natural resources and energy. There is evidence that trade globalization may already reach the peak, and the potential for further financial globalization would stem mainly from developing in emerging economies. The global value of trade as a ratio of world GDP peaked at 64% in 2008, compared to an average of less than 40% in the 80s. Over this period, from the 1990s to 2007, in real terms, the trade volume of goods and services grew at a remarkable pace of around 7% per year, while it posted a meager rate of less than 3% in the past few years. Overall, according to IMF projections, world trade seems to have stabilized relative to world GDP around a plateau close to the levels reached in 2011. The financial crisis has been accompanied by a significant retrenchment in cross-border financial flows, and in particular concentrated in banking flows, and to a lesser extent, portfolio and FDI flows. Across advanced economies, a revival of the boom in financial integration that we have experienced in the first decade of this century is unlikely. Nevertheless, the scope for financial deepening and capital account liberalization is still large across emerging markets. These represent an opportunity and at the same time an important challenge for emerging markets, the second pillar of the growth of the world economy. Let me then briefly discuss the role played by emerging markets. For the first time, at the end of last year, the share of emerging markets and developing economies' GDP relatively to the world GDP surpassed the threshold of 50% when measured in purchase power parities. From now on, it is legitimate to expect that the value added produced by emerging and developing economies every year will be larger than that produced by advanced ones. Moreover, emerging markets are expected to grow at a pace of more than 5% on annual basis, more than twice the pace of advanced economies, so that their share in the world economy is bound to grow further. Can emerging markets represent an independent source of world growth? It is questionable that this will be the case. Much of the catching up potential that emerging markets had in the beginning of the 90s in terms of capital accumulation, innovation, and employment growth has already been realized. Over the medium to long term, the growth path of emerging markets may remain bumpy, in particular if emerging markets should fail to manage the process of financial and capital account liberalization, or as in the case of China, small and medium, or in the case of China, the needed rebalance from investment to consumption as a main driver of domestic growth. The third pillar to longer-term growth is further technological progress. Recent work from one of the major scholars in the growth theory, Robert Gordon, offers a particular downbeat assessment of the future of innovation. His main tenet is that innovation is not a continuous process, but a discrete one where waves of inventions are followed by their application and refinement to extract their full potential. Against this metric, though, the latest ICT revolution, having generated a rather short-lived increase in productivity, ranks well below the previous industrial revolutions, in particular in terms of creation of employments. Even if the rate of technological process should continue at the same pace or even accelerate, according to Gordon, the US economy in any case faces severe headwinds along with other advanced economies due to demography, education costs, inequality, globalization, energy, environment problems, and the overhang of consumer and government debt. The pessimism of Gordon seems to have been rather contagious. Late last year, Paul Krugman first and then Lawrence Summers wondered whether advanced economies were slipping into a state of secular stagnation. This could be depicted as a condition where the natural and equilibrium interest rate, the rate equalizing desired savings and investment at full employment, is negative, and economies are forced to generate bubbles and an overhang of private or public debt to support aggregate demand. Research at the BIS shows that accounting for the financial cycle, including in particular information on the growth and credit and property prices, potential output estimates are much lower before the crisis and display less volatility during the crisis. This can be reconciled with the view reflecting the unsustainable nature of pre-crisis financial cycle. The main concern is that this potential secular stagnation severely curtails the possibility to use the traditional policy levers, hampering the growth of advanced economies below potential. On the one hand, the zero lower bound to nominal interest rates constrains the monetary policy. On the other hand, after the governments have absorbed the liabilities of the private sector following the burst of the bubble and public debts have swollen, the room for expansionary fiscal policies is also limited. Is the euro area at risk of ending up in secular stagnation? Looking forward, what are then the growth prospects and challenges for the euro area? On the back of the fall in capital accumulation and labor utilization, the euro area potential output growth declined from a level of close to 2% in the years preceding the crisis to less than 1% on average between 2008 and 2012. Notably, total factor productivity, a gauge of efficiency of the use of the factors of production, even though subdued, contributed only marginally to this decline. However, over the medium to long term, cyclical factors dragging down potential output are expected to fade, with investment recovering through the normalization of the credit channel and net emigration, which has also an indirect impact through an increase in the fertility rate returning to support the employment contribution. According to the estimates of the European Commission Aging Working Group, euro area potential output growth is expected to rebound to around 1.5 until 2025, mainly on the back of a positive contribution from labor productivity growth. For the euro area, the main structural challenge is represented by the aging of the population and the ensuing decline in the share of working age population. According to the CEPS report already mentioned, the European working age population will decline annually by 0.6% until 2030. Meaning that the contribution of labor to potential output is projected to become negative. Potential output is expected to be supported by capital deepening around 0.5 percentage point and, crucially, total factor productivity, assuming that it returns to grow at an annual pace close to 1%, the rate prevailing at the beginning of the previous decade. Unfortunately, since the start of the crisis, euro area total factor productivity growth has remained subdued, falling behind the productivity growth in the United States, where it rebounded after the bottom of 2009. The crisis and the persistent low levels of capacity utilization led to a destruction of human capital in those firms and sectors experiences the most dramatic downsizing. In the euro area, the greater rigidity of the labor and product market regulation compared to the United States is likely to have hampered the needed reallocation of resources towards the most productive sectors. I will come back later on this. The point I want to make now is that there are downside risks to the long-term projections for the growth of euro area total factor productivity unless the euro area implements those reforms that foster innovation, competitiveness, and the reallocation of resources towards the more productive sectors. What can policy do? During the financial crisis and the ensuing sovereign debt risk, policy was most focused on stabilization. Restoring confidence in the banking system and repairing excessive indebtedness were the two most pressing concerns, and they were addressed forcibly. Today, the euro area economies have largely been stabilized relatively to 3 or 5 years ago. Based on current trends, the euro area is facing a medium-term future of stable but low growth, with unemployment evolving to lower levels in 15 years' time as a result of a declining active population. Europe has to react swiftly if it wants to avoid that a whole generation is wasted and sacrificed. Can structural reforms provide a solution in the long run? There is not much that we can do about the aging of the population because European politics is refusing immigration and is going Malthusian. In this context, can policy address the dual problems of weak demand and slack industrial capacity? Regarding demand, only a few countries have financial space to stimulate consumption and, more importantly, to increase some public investment in a context of very low interest rates. That is the answer that Bernanke and Blanchard, among others, have suggested to dispel the risks of secular stagnation. The reality is nevertheless that Europe as a whole is still pursuing consolidation to achieve a reduction of debt ratios. In this context, the challenge is to counter the structural impediments driving potential growth down, above all, the negative demographic trends in a condition where the scope and effectiveness of conventional macroeconomic policies is reduced. I will contend that it is of paramount importance to carry out those structural reforms that may increase the participation rate of the labor force and lead to a more efficient use of factors of production. Reforms aiming at increasing investment and employment in the most productive sectors are particularly needed at the current juncture. The preliminary findings of our Eurosystem CompNet network, which has collected competitiveness indicators across a huge sample of about 700,000 firms from 11 EU countries, show a strong heterogeneous situation of firm labor productivity within and across countries. The distribution of firms' productivity or the cost structure is not only very dispersed, but also very asymmetric. There are few champions and a high proportion of low-performance firms. For policymakers, this has two major implications. First, when talking about competitiveness of productivity of a country, we must go much deeper than looking at simple average indicators such as unit labor costs or market shares. The same policy intervention may produce different results depending on the initial distribution of firms' productivity, even if average productivity is the same. Second, dispersion and skewness of firms' distribution have important implications for aggregate productivity growth. Labor market reforms have also been advocated by many economists. A widely shared view during the 90s was that the labor market institutions were too rigid and that the common currency would make reform of these markets even more urgent. In the absence of country-specific monetary policy and with national fiscal policy bound by rules, labor market flexibility needed to become an important channel of adjustment. This adds to the fact that labor mobility across national borders is traditionally low, with migration responding considerably more slowly to regional labor shocks than in the US. The crisis itself had a more pernicious and long-lasting effect on the euro area labor market through the increase in structural unemployment and skills mismatch, with the unemployment rates of those staying longer out of work and with lower skills increasing more than proportionally compared to the average unemployment rate. Pressed against the wall, however, governments have recently acted to provide a legal framework for more growth. For example, countries like Greece, Portugal, or Spain have reformed their legislation to reduce the burden on firms and encouraging higher and labor mobility. More can be done to reduce the corporate labor burden further and to ensure a level playing field that does not hinder young people and just favors insiders. Encouraging more flexible governance structure of labor market institutions accompanied by an appropriate social safety net and active labor policies can also contribute to a reallocation towards more productive sectors. Policymakers also have to tackle the long-term consequences of youth unemployment by reducing its negative impact. One such policy that has proved effective in the past is training. On-the-job training provides workers with general, but especially with industry-specific skills that are indispensable in today's knowledge economy. Subsidizing R&D can be another policy targeting an improvement in longer-term productivity in a low-growth environment. Contrary to theoretical predictions, recent evidence suggests that R&D investment tends to be pro-cyclical. So rather than picking up during recession when the opportunity costs of innovation is lower, as a number of theories have suggested in the past, R&D investment tends to fall dramatically when demand is low. If the market allocates an inefficiently low fraction of innovative promoting activities to recessions, then there is a clear role for policy in the form of countercyclical R&D subsidies. Finally, there is evidence that policies aiming at increasing self-employment and small firm creation, such as reducing corporate tax rates and barriers to entry, can have substantial positive effects on new business creation and firm dynamism. Let me conclude. I have argued that while finance is important for growth, completing the repair of the euro area's financial system is an essential condition, but will not be sufficient to jumpstart the economy. Europe has turned a corner after a dangerous period of turmoil. The sovereign debt crisis has been stabilized, redenomination tail risks were overcome, and financial markets have recovered buoyancy. ECB decisions and the painful adjustment in stressed countries were mostly responsible for those achievements. We have now a period of financial stability, but we face the double risk of short-term high unemployment with low inflation that aggravates the burden of the debt overhang, combined with a long-term risk of quite low potential growth. The aftermath of the financial crisis and the policies to face it left behind a labor force weakened by hysteresis effects, which combined with low levels of investment have reduced potential growth. In the long term, this is also negatively affected by weak demographics. Policies to foster total factor productivity are crucial to improve growth prospects and help absorb the high unemployment and reduce the debt overhang. Monetary policy has been accommodative and helped to stabilize the economy, but after a banking crisis that weakened economic agents' balance sheets, we all know that monetary policy becomes that monetary policy loses some effectiveness. Nevertheless, monetary policy will continue to provide some stimulus, and this posture has been several times confirmed by our forward guidance and by the recent statement by the ECB Governing Council that it was unanimous in its commitment to using also unconventional instruments within our mandate to cope effectively with risks of a too prolonged period of low inflation. Also, the ECB will do its best in its role as the single supervisory mechanism to fix the bank lending channel. However, it is important to warn that monetary policy cannot do everything, and that people seem to expect too much from central banks. Governments have to accept responsibility for measures that favor investment and increase demand, foster R&D and technological innovation, improve education levels, and implement active labor market reforms and policies. All advanced economies, albeit in different degrees, seem to have been caught in a trap of relative low growth and low inflation. Many commentators seem just to be waiting for the godot of a new wave of technical innovation that will save the day. Maybe it will come, but I'm sure we also need active policies and new economic thinking to deal with income distribution problems that the coming technology will aggravate, as well as the role of finance and demand in monetary economies, where it is wrong to try to reduce macroeconomics to narrow real and long-term supply-side considerations, as our present predicament so impressively demonstrates. Thank you. Yes, please, of course. Yeah, I'm sure. Yeah. I'm sorry.
Let's come up front. Wait for the mic, please. We'll go to the gentleman on the corner and then to you. Thank you.
Paul Gallagher, EIR Economics. With regard to your complacent view of the balance sheets and the capital ratios of the European banks, if that's the case, why did the European regulators just go backwards to 3% capital ratio requirements? Why did they go backwards to allowing more of the derivatives exposure of those banks to stay off their balance sheets? And secondly, why are those banks declining in their lending, I think by something like 3% a year or nearly so now? Secondly, if demand is the problem, why has the Troika imposed these deadly austerity programs in order to save the euro? Why not encourage those countries to leave the euro and use their own currencies as the basis for investment and credit?
Mm-hmm. Okay. On the first question, well, I don't think it is there is any complacency in our attitude. We do think that the markets and many analysts, in particular in the US, I would say, have taken a too negative view on the European banks. And it's not for nothing that since the beginning of last year, the stock prices of European banks have increased by more than 40%, the double of the increase of the market as a whole. Stock markets have begun to recognize that the banks in Europe have increased capital, have increased provisions, most of those measures front-loading our own comprehensive assessment that we are going to conduct, and that the situation had certainly improved, and that was recognized and rewarded by the stock market. Also, just to quote you another figure, which comes from the US, that's why I also want to quote it. Last year, Thomas Oening, the deputy chairman of the FDIC, made a speech in Europe, and for the first time, an official entity, in this case the FDIC, compared the leverage ratios, tangible equity over tangible assets, of the American top banks and the European top banks measured with the same accounting system. because it shows in that table published by the FDIC that if you take the US gaps, the average leverage ratio of the top American banks was 6.2, whereas using our IFRSs, the average of the European banks in the sample was 3.6. But then, for the first time, it recalculates the leverage ratio of the American banks using also IFRSs. And the 6.2 come down to 3.8. So not so much bigger tangible equity over tangible assets. So there is no complacency. And the 3%, I suppose you were referring to the leverage ratio, that's a Basel decision for all countries, not just for European countries. And what has been announced recently was that the method to calculate the leverage ratio was agreed, but the calibration is still to be revised. And there have been several public interventions of responsible governors and heads of supervision in Europe, hinting that the 3% should be increased. And that's what also I said in my intervention, that the 3% with the new netting rules that were approved in the new definition of the leverage ratio, the 3% would be now too low. We will see what will come out of the final decision, but there is still no final decision on the calibration. And as you know, quite recently, the US decided on 5 with that definition. So on the demand thing and the policies, and the idea that countries would leave and then come back. Well, I can tell you, no country expressed such a preference to do so. So they certainly were not prohibited to do it because none of them really express that preference. And then it was a question of adjustment, which also involved the IMF in the traditional approach that countries with reduced or no access to financial markets have to respond by reducing their deficits and trying to reduce their debt ratios. So there are problems in such programs. The IMF itself later recognized that the multipliers that have been used to initially for some of those programs were not the appropriate ones because they were higher. In reality, they were higher than they had estimated. That had consequences, of course, but this is, in a way, things that happen in such programs.
The gentleman in front.
Thank you. Krishna Guha, former New York Fed, now vice chairman of ISI, a broker-dealer firm here in the US. I thought you made it very clear, very thoughtfully, why we should be careful to remember that there's more to economic policy than monetary policy alone.
Yeah, right.
Nonetheless, I think you also highlighted a few points that argue very much in the direction of a highly accommodative policy, notably the fact that the supply side may be endogenous to weak demand.
Yeah.
And secondly, that restoring a strongly capitalized banking system may be a necessary but not a sufficient condition for restoring high levels of activity. So on the face of it, it would seem to me that your analysis argues that there is still a material role potentially at the margin for monetary policy to play as a contributor to the outcome. I wonder if you could comment on that more further.
Yeah. I agree with that, and that's why we have been considering further measures of stimulus on monetary policy. Although today I aimed at pointing to the need of other policies and not just relying on what central banks can do. We will do something because the situation is that inflation is indeed very low. And even considering only our primary mandate of price stability, we are clearly not achieving our target of having, on a medium-term basis, inflation close but below 2%. So we have really, and we do take seriously our mandate. We have done some extraordinary measures in the past. Recall, beginning of 2012, our huge liquidity provision operations, 3 years maturity. Unfortunately, it was very useful to respond to the situation in funding markets at that particular moment, so it avoided a much bigger credit crunch, but it was not enough to jumpstart credit growth and monetary aggregates. It was not. And so it was, as it was our traditional way of doing monetary policy by lending to the banks, it showed that the channel was impaired, that there was no increase either in credit or in monetary aggregates. So we have to consider other things. And of course, as you know, asset purchases is a possibility that we are studying because on many other points that also such a policy would achieve, it would also more directly put central bank liquidity in the hands of non-bank economic agents with consequences in the economy, meaning it is a different way and a different channel of using our balance sheet. We have not shied away of using it in 2012. Now we have to consider what is the more effective way of using it to face the situation. And the recent statement unanimously approved by the Governing Council is an indication in that direction, although no concrete decision has yet been taken.
I'm afraid we're out of time. Thank you very much.
Okay.